Today's show is brought to you by our sponsors at Betterment Advisor Solutions. If you happen to be thinking, there's got to be a better way to grow my RIA, you're not alone. Betterment Advisor Solutions, we do the heavy lifting so you can focus on what matters most to your clients. From improved service that makes asset transitions smoother, to fast, paper-free onboarding that delights clients on day one, we've built a digital-first platform designed to streamline your operations and make life easier. Now, if you're thinking, wow, they take the paper out of paperwork, then you'd be right. Grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk, performance not guaranteed. Welcome back to another episode of Ben with Benefits. Today I have a very special guest. Bill Bengen is a former financial advisor and creator of the 4% rule. Bill, welcome to the show.
Ben, thanks so much for inviting me. Glad to be here.
So retirement withdrawal rates are a huge point of discussion today because there are 70 million baby boomers retiring or thinking about retiring, and they're all scrambling to figure out, either by themselves or with their financial advisor, how do I safely spend down this nest egg that I've built? Your original paper, Determining Withdrawal Rates Using Historical Data, was published back in 1994. So you were way ahead of the game on this. What was the impetus for you going down this path? Were you going through these conversations with clients? Why were you so far ahead of the game on this idea?
Yeah, I guess I was an early baby boomer myself with a lot of early baby boomer clients who had just in the early 1990s just beginning to think about retirement and how much they should save and how much they could afford to spend. So they started asking me questions about that, and I tried to find answers, couldn't find answers anywhere in my library, magazines, publications, my CFP manuals, nothing. So I decided to just go ahead and research the whole topic myself and see what I come up with.
So I've read the original paper a few times now, and I just want to go through some basic assumptions, and you can stop me and tell me if I'm wrong on any of them. But you looked at, 30-year periods of
Right.
safe withdrawal rates. You did, 50-50 portfolio stocks and bonds. You start off with 4% of that original portfolio value and increase for inflation each year. And then
Yeah.
you rebalance your portfolio. Is that pretty right so far in terms of your research?
Yeah, I think the paper actually said 4.15%, but
Yeah, they
nobody,
rounded down to the 4% rule, right?
that's
Now,
that's natural.
my interpretation is I think a lot of people misinterpret your research. They kind of assume that the 4% rule is like the base case, right? But didn't your research essentially show that the 4% rule was kind of protecting you from the worst case scenario, right? It was kind of, you want to protect against those really terrible 1970 style events or Great Depression. Isn't that the idea of the 4% rule?
And you're absolutely correct, Ben. Originally, my goal was to find out what was the safe withdrawal rate that you could get you through any past historical problems with markets. And so I set it up with that. And it's interesting to note that, I study 400 retirees retiring to January 1, 1926 to date on a quarterly basis. So there are only 400 retirees. Only one of them does that particular rule apply to. That's the one retired in October of 68. They ran into a buzzsaw of the bear markets and high inflation. All the others had higher withdrawal rates, and some much higher. In fact, the historical average over the last 100 years, believe it or not, is about 7% or slightly more than that. So if you're looking at 4.7%, which is my current view of the rule, you're taking a lot less than the average person might have been able to historically.
So that's interesting that the 1970s were the one that killed you because of the high inflation. So I'm just curious how much you think your approach changes depending on the inflation rate or bond yields. I know a number of years ago when bond yields were on the floor, a lot of people asked you, does the 4% rule still apply with low bond yields? But do you think that people's process should drastically change if inflation is higher or bond yields are lower? Because obviously we have higher bond yields now, which is nice, but people are still worried about inflation.
Yeah, and determining your number, your safe withdrawal rate, inflation is a very, very important factor, as well as stock market valuation. So yeah, the answer to that is definitely so. The higher the inflation rate is, the lower your withdrawal rate is going to be, because the more demands is going to be put on your portfolio, assuming you want to increase your withdrawals each year with inflation.
Right.
And during the 70s, when they had double-digit inflation, they were doing 10, 12% increases each year, and that was pretty devastating for the portfolio.
Yeah, and obviously everyone has their own personal inflation rate, right? Not everyone has the inflation rate of the overall economy. So I guess a lot of it depends on how much your spending changes from year to year. So you can essentially set that yourself as long as you're keeping up with whatever your standard of living is.
That's right. Yeah, basically part of my method is determine what do you think, what kind of inflation regime do you think you're in? And that's a very personal question, as you mentioned. Varies from individual to individual.
So I know that
Even
you looked at different allocations as well. What does a change in allocation say? Because I think you looked also at like 75-25 portfolios. So
yeah.
maybe people who are more comfortable including stocks, and maybe the reason for that is, retirements are longer these days because people are living longer. So how does that change the shape of the outcomes if you include more stocks in a portfolio?
Well, if you're looking just at the worst case scenario, which we shouldn't do exclusively, there's a flat spot on the curve where you could have anywhere from 46% stocks to 73% stocks and end up with basically the same 4.7% withdrawal rate. If you go higher than that in stocks for that particular individual or 68 retiree, the rate drops off because you ran into the major bear markets in stocks, which depleted his portfolio. And if you go on the low end, where you have mainly bonds, that just doesn't have enough return to generate what you need to have a good withdrawal rate. So it's important to recognize this is just one individual. When we talk about that 46 to 75% range of, there are many cases where people retire early in a bull market, let's say 1982, 1975, maybe 2009. They probably could have taken out almost 100% in stocks and kept it at that and would have done very successfully because they got such a huge cushion they built up in their early years.
Right. So what do you think about other forms of diversification? Are you super comfortable with just having a traditional stock bond balanced portfolio? Because I know now advisors these days are trying to use alternatives. There's a lot more advisors who are comfortable using private investments. Does your research still just focus on these traditional stock and bond mixes? Because obviously they have the longest historical track record.
Yeah, and that's why I've used them. Yeah, I primarily focus on those because most people, I think, are probably going to use those. There are some interesting alternatives you mentioned, but how well they'll perform over the long term, I'm not sure because their track record is relatively short. So I try to stick with what I know based on what history is telling me.
How has your thinking on this idea evolved over the past 30 plus years or whatever since you first started this?
Well, for many, many years, I had a real problem in that I knew that historically, many retirees were able to get much higher withdrawal rates than 4.7%. But I could not find a method of determining what that rate should be. And finally, a couple of summers ago, I had an aha moment and I said, well, let's make inflation important as an early stock bear market. When you sort things by inflation and then by stock market valuation, the picture develops very neatly. And you can use both inflation and stock market valuation to give you a pretty accurate fix on what your safe withdrawal rate is probably going to be.
So does that mean what's the relationship there? Higher inflation just means a lower withdrawal rate. Lower inflation means a higher withdrawal rate.
Right? And higher stock market valuation means a lower withdrawal rate and vice versa.
Okay, that makes sense. So you talked about it before. You said the average over historically, however long you're looking, is like more like 7%. So Michael Kitces, I know you've talked to him before, and I've heard you on his
Yeah.
podcast. He did this study a number of years ago where he looked at the upside surprises in sequence of return risk, and you talked about the fact that the sequence of return risk is big. Depending on when you retire, that can have a big outcome. And so
Yeah.
he basically looked at not only the worst case but the best case. And I think he said the median. He looked at all these Monte Carlo 30-year periods. The median is that you end up with almost 3 times as much of your starting principal. But he said that you're just as likely to grow your portfolio by 800% as you are of running out of money. So there's like this other thing here where obviously it's a good problem to have, right? You end up
Yeah.
with more money than you originally thought, but
Yeah.
how do you take that kind of thing into account where things are just better? Do you advocate for a more flexible approach when, hey, listen, after 10 years, I realize I'm way further ahead than I ever thought I would be. Now I can crank it up, or how much flexibility do you like in the process, depending on how things
Yeah.
turn out for you?
Yeah. We use inflation and stock market valuation as kind of a beginning of, to our plan and set the withdrawal rate based on them. But a 30-year plan is a long range plan and you just can't let it go unattended. So, yeah, you need to revisit it periodically. And I recommend you have some kind of template or some kind of a model showing you what you think your withdrawal rate should be each year based on the assumptions, and measure your actual withdrawal rate against that. And if it deviates, then maybe it's time to make some changes.
Right, because we know that not everyone spends the same money year in and year out. There could be big family vacations. There could be one-off things that you
Yeah,
have to replace a roof or something. And obviously there are some retirees, most retirees probably spend more money, and the data shows this. People spend more money in their 60s and 70s than they do in their 80s and 90s, right? So how would you think about something like front loading? How much risk would that put your plan at if you decide I'm going to spend more in my first 15 to 20 years of retirement because I think I'm going to spend less in my last 10 to 15 years or however long I end up living?
sure. You're basically talking about changing what I call a withdrawal scheme. My basic research assumes that you're going to increase inflation with inflation each year, your withdrawals, just like Social Security, give yourself a COLA, cost of living adjustment each year. But you don't have to. You can start out, as you said, saying, "Hey, I want to spend a lot more now," and then maybe after 10 years, cut back. And it's in my book. I've studied that method, and I've indicated that it's viable, but you have to be prepared for pretty steep reduction in your expenses, maybe 30%, maybe more. And if you can handle that, that's great. And you should
Right.
do
So
it.
so you're saying in like the worst case scenario, if you decide to spend more money plus you hit a bear market, that could be a double whammy against your plan essentially.
Yeah, hopefully we figured the withdrawal rate accurately from the stock market valuation. Usually bear markets, major bear markets don't occur except around periods of really high stock market valuation. So that if you knew that coming in, then we would have had a lower withdrawal rate to begin with.
Right. So you mentioned your withdrawal rate today is around what do you say 4.7%? So
Yeah, that's the worst case. Yeah.
okay, so what goes into giving you confidence in that value? Is that you're
Well,
again basing
actually,
it on inflation rates and stock market valuations?
yeah, that's just the worst case scenario.
Right.
Currently, based on my take on the markets and inflation, I think somewhere between 5.25 5.5% is acceptable. It'll get you
Okay.
through 30 years.
Yeah, that
Uh,
makes sense. So in your personal you're retired as a financial advisor, I think.
yeah,
Um, what's your withdrawal rate? How do you do this personally? What does your plan look
sure.
like?
When I did this, well, I retired back in 2013, and at that time I had earlier versions of my research recommending 4.5%. So, being a very conservative person, I use that number. But of course, the stock market has done so well.
Yeah, you timed it pretty good actually. Right at new all-time highs and a bull market ever since, 10 plus years, right?
I'm surprised I haven't had job offers as a market timer, quite frankly. But yeah, it worked out very well. We've had great stock markets. Every time the market dips, it seems to come back with a vengeance, which I don't know if it's completely normal behavior. It's what we're in right now.
Yeah. So have you made any changes over the years? Have you seen like, hey, this worked out a little better than I thought it would? Have you turned the dial up and down and spent a little more because of the bull
Yes.
market, or are you still keeping things relatively steady?
Yeah, I have adjusted it. I will spend more. I mean, well, usually, what I do, part of my budget is giving money to my kids each year, and I just increase that segment, as much as I can.
I'm gonna put you in touch with my parents just in case.
Okay, sure. I'll be glad to talk to them.
Just you can explain that one to them. But yeah, no, that's another conversation we have. I actually had my colleague Nick Majuli on the show last month, and he was saying, listen, in terms of giving your inheritance, it moves the needle more if you give to your kids when they're younger and have more responsibilities and need the money, right? Than it would be to keep growing that money and give it to them at a later date after you
Yeah,
pass, right?
I think so. I know that's something my dad did with me, and I know remember how much I appreciated his gifts. When I was working full time and uh, struggling. So that was great. So I want to make sure I did the same for my kids.
So I mentioned that there's a lot of misinterpretations of your rule, and you said I've heard you say this before that I didn't set out the 4% rule. You said it was 4.25 or whatever it was. You didn't land exactly on four, but that it just has a better ring to it. Any other misinterpretations you see people making of this rule over the years, as it's now been, like I said, 3 decades since you initially rolled it out?
Yeah, one of the main things I see people think they're supposed to take out 4% every year of the book value. Well, that's not correct. It's only applies to the first year. Years after that, you follow the Social Security rules. Where you just give yourself a cost of a living adjustment.
Right. If you did 4% of the value of your portfolio, and I think I've looked at that, the
Yeah.
volatility of your spending would be all over the map, right? So the point is, as a retiree, you want to keep it relatively consistent because most people in their salaried life or their income life, they have relatively consistent money coming in as well.
Yeah, it varies very much from person to person.
So I'm curious how much feedback you've gotten from financial advisors over the years, and any good sort of changes or minor additions or subtractions that they've made to your rule. Because, like I said, a lot of financial advisors are trying to figure this out themselves and help their clients. And obviously, there's no one size fits all rule. But any good feedback you've gotten from advisors over the years in terms of how they've applied your research?
Well, I get a lot of and have received a lot of comments from my fellow advisors, mostly gratitude, for the work I've done, which humbles me that I'm able to make a contribution past retirement, continuing. But the idea is to get it right, study it until we get it right.
Yeah. No, and I think it is for a lot of people, it's a moving target. Again, depending on your client's circumstances and then what happens in the market and inflation and valuations and rates and all these things. So that's the thing is it kind of keep moving. How often, so you said you've got your number in mind these days. How often are you updating that number? Are you looking at this on like a quarterly or annually basis to
No,
see
I
where
look
it's
at it
at?
annually. I look
Okay.
annually. Anything more than that can lead to,
Yeah, you don't want
vol
to screw with it all the time, right?
no, it's volatility can play with your mind in the stock market. So,
Yeah, and when the thing is when you're retired, you don't want to be nitpicking this stuff and looking at it on a daily or a monthly or bi-monthly basis, right?
uh, no, I wouldn't recommend that. And it's no longer a plan then; it's a plaything. And this is a serious business. So get a plan and stick with it until something happens where it's clear a change needs to be made. And it's not always clear that a change needs to be made. Let's say you go in retirement and you're not expecting a bear market, and a big bear market just shows up on your front door early in retirement. You may not have to make any adjustments, even though your withdrawal rate temporarily may rise. Maybe it goes from 5% to 7 or 8, 9%. It's very upsetting. But generally, because of the strong recoveries that stock markets make, if you just sit by and do nothing, you'll find out that over a couple of years, the plan will come back into register by itself. Well, important not to overreact to
Yeah,
changes in
no,
the
I
market.
I totally agree because as long as you build a margin of safety, and one of my favorite readers of my blog kind of has updated me over the years, and he said he retired in 2000, right as the tech boom crested and the dot-com bubble blew up,
Right.
right? So
Tough time.
he was feeling great at the time because stocks were so high after a 20-year bull market. But then he retired right into the teeth of two crashes in a lost decade. And he said, listen, it was really tough, but I had a plan and I followed it. And that plan included keeping some cash reserves for a few years. So
Good.
you didn't have to sell stocks when they're down. And he said that decade was really hard, but on the other side of it, I came out and as long as I followed my plan, it actually still worked, even though that was a really difficult period. And I guess from your perspective, one of the good things is even though that was a difficult stock market period, the inflation was low. So I suppose that helped.
Yeah.
Um, so you've got a new book dropping any day now. Do you have a date for the publication?
Yeah. August 5th.
Okay, August 5th. So maybe by the time this airs, we'll be pretty close to that. And I like the subheading. So you say supercharging. It's a richer retirement is the name of the book. Supercharging the 4% rule to spend more and enjoy more. And I like this subheading because this has been a huge topic of conversation with me on this show and also with clients. So I'm sure you've experienced this in the past. Most people spend their entire career building a business or building wealth over, say, 30 to 40-year period, right? They're very good at saving and investing, but then they have to flip the switch when they retire. And all of a sudden becoming a spender can be very difficult because they've delayed gratification and delayed and delayed and delayed. And then they just want to keep on delaying because it's like, I don't want to touch the principal. I want to live on the income, right? I'm too scared because of all these uncertainties involved in retirement. How much is healthcare going to cost? How long am I going to live? I don't know these things. So what is your take on helping people actually enjoy the fruits of their labor when they have a difficult time psychologically doing so? This is even, wealthy people have a hard time
Yeah.
turning that around and saying, how do I have to spend it? This is scary.
Well, one thing I recommend to folks is that they use a much longer planning horizon than their life expectancy. Let's say their life expectancy is 25 years. You may want to use a 35 to 40-year time period for your plan because that builds in a margin of error. If things don't quite as well, you may not be able to make 40 years, but you'll probably make it 25 with ease. And that's really important because life expectancy and planning horizon are really two different things.
So how do you, I guess, do you think your rule helps people at least spend a little more? Because I've seen these safe withdrawal rates of, hey, listen, I'm just spending the interest income on my bonds and the dividend yield on my stocks. I'm not touching the principal. Do you think your 4% rule or 5% or whatever the number is at least helps people get a little more comfortable spending that money? So they know that they have a plan in place and it's hopefully going to keep them safe. And you use the word safe as a way to cut off kind of the left tail event, right? Do you think that your rule at least will help people spend that money a little more freely?
I sure hope so, because that's a problem among retirees. They just don't spend enough. And as you mentioned, a lot of folks who spend so conservatively, they're not touching principal. Our principal just keeps growing and growing. And you get to 90s, you're wondering why you have all that money, what you could have done.
So what else are you covering in the book? Not to give everything away, but what other topics are we talking here?
Well, it's just the management of your plan. I alluded to that a little bit when I said, when the stock market drops, don't overreact to it. By the same token, if you come into a period of unexpected high inflation like the 1970s all over again, I hope we never see that again. That was horrible. Inflation should be addressed immediately. You should not wait. You should make cuts to your spending until things look like they're going to improve, because if you don't, the longer you wait, the more devastating the effect will be on your plan.
Right. And we got a mini little bout of that earlier this decade, obviously, where people had, 70s style inflation, at least for a year or so, and had to kind of think about that. But I agree that I think that's the thing that matters most is how willing you're able to adapt to the environment, right? If it's really high inflation and a bad stock market, you might have to turn the dial down a little bit. If things are going great for a long time, as you've experienced throughout your retirement, then maybe you can dial it up a little bit and enjoy it a little more, right?
I think so. I mean, there are folks who retired in the late 80s into that huge bull market, probably with very modest expectation for withdrawals, but then they made so much money. They were actually able to increase their withdrawals substantially going into the 90s.
So in your experience with clients back in the day, when you first rolled this out, what was the range of withdrawal rates that your clients were in? Were they pretty close to hitting those targets you were laying out, or were people going above or below what you were laying out for them?
Well, ultimately the client's preferences rule. If a client wants to take 2.8%, and I show him that maybe a little bit too conservative, but he or she wants to do it, that's what we're going to do. So I had clients ranging from like 2.5% up to 6.5%. And we just made sure that we monitor their plan on an annual basis, make sure it was staying accurate.
Yeah. So our audience here is mostly financial advisors. So what is your advice for those advisors who are trying to shepherd their clients through a smooth withdrawal process to retirement? What do you tell them in terms of making sure this process goes smoothly, not only for them, but for their clients?
Yeah, important you understand what's happened historically, effective bear markets, inflation on your portfolio, and that they explain as well as they can to clients how those factors interact and create a withdrawal rate. And that if you do it properly, your withdrawal rate should be a little bit on the conservative side, and you can go from there with some confidence.
All right, Bill, remind everyone the name of your book, and then again, when it's going to be released.
Yes, A Rich Retirement, Supercharging the 4% Rule to Spend More and Enjoy More. That'll be coming out August 5th, although you can pre-order it on just about any major internet bookseller right now.
Perfect. Thanks so much, Bill. I appreciate the time. Advisors, subscribe to the Unlock YouTube channel if you have not yet. Michael, Josh, and I are going to be hosting way more of these conversations going forward. And then subscribe at advisorunlock.com for the newsletter. We're talking all things wealth management. Bill, thanks again for coming on, and we'll see everyone next time.
Thanks. I enjoyed it, Ben.